We can start now. Okay. Eileen, thanks for joining. I'm really excited about Carnation. It's wine investing has been kind of horrific the last couple of years in a lot of spaces, but one bright spot that we sort of found is wine trade finance. So I'm really excited to learn about this. It seems like one of those examples of unsexy ways to invest in sexy industries, and that's actually where you make all of the money. But yeah, I'd love to hear more about you and more about Carnation.
Yeah, thanks, Wyatt. I'm very excited to be here. So yes, let me maybe start with introducing myself, just so that I can kind of put a face to a name for your investors and your community, and so they know who is that person behind the investor communications and the deal structuring and the deal origination, and also how my background and my experience has kind of given me that advantage to bring together private credit and the wine and spirits industry together in Carnation Capital's fund strategy. So actually right now I'm based in Bordeaux. I've been living here for the last 2 years. Before that, I was living in London, and I spent most of my career with HSBC investment banking in oil and gas. So I know the first thought is that oil and gas has nothing to do with wine and spirits, but actually the principles are quite similar. So if you think about a oil producer in country A, and they need to send that oil barrel to customer in country B, there you have kind of payment terms, whether that's 30, 60, 90 days, and then you have an invoice and or a receivable to finance. You then also have the value of the asset itself, the oil. And so a lot of my credit and lending kind of experience was looking at asset-based lending. So that kind of gave me the foundation in trade credit and in trade finance, and also in debt lending that I apply now to Carnation Capital. At the same time, kind of as a break also from oil and gas, is how I started with WSET level 2. So that was just purely for interest and passion, but I absolutely loved it.
So what does that mean?
This is the Wine and Spirits Education Trust. So I highly recommend it to anyone who might have an interest in wine and spirits. Fantastic course, but be careful. It kind of does take you down a rabbit hole, which is kind of what I did, and I went and did level 3 as well. Loved that, and at this point, I said to myself, okay, maybe I should think about working in the wine and spirits industry. So then I joined a US-based wine investment company, and I was responsible for managing all the clients in the company and also the portfolio of those clients, which was at the time about 80 million US dollars. And what I took away from that experience was, most importantly, the investor feedback. And I saw that the speculative model, as you say, especially in market upturns and downturns, that speculation isn't necessarily for every investor. And I had in the front of my mind that the kind of most crucial feedback was that they wanted consistent and transparent returns. So knowing that that's what the kind of investor was looking for, I then wanted to complement that with, what does the wine and spirits industry want and need? What are they looking for to support their trade and support their growth? So then at this point, I mentioned the rabbit hole, I then moved to Bordeaux. So at the same time, I then also I started the level 4 course, which is a diploma level of the Wine and Spirits Education Trust. Now, both together was such a kind of fantastic start to my time in Bordeaux, and also being on the ground here, I can kind of meet with the chateaus, we meet with the negociants and the distributors in person, establish those direct relationships, which has helped for kind of direct allocation and experiences, but also hearing from the horse's mouth, what are their pain points, what are their kind of financing needs for their sales and trading. And what was clear was that they were being underserviced by the big banks, by the traditional banks that frankly, are there for a very important reason, but just can't move necessarily quick enough, are not innovative enough to look at different debt structures or blends of debt and equity, or really understand the value of the inventory itself. So I then said to myself, okay, I wanted to really consolidate that knowledge and see how could I apply private credit in this industry. And so I joined then a boutique private credit firm that was specialized in lending to small and medium-sized businesses. And that for me was a way to really, again, kind of consolidate the debt structuring and the deal origination side for this kind of solution. So all in all to say that the intention was then to bring together all that experience, the investment banking at HSBC, the investor feedback from the Wine Investment Fund, and the private credit kind of deal structuring, and the WSET kind of theoretical wine knowledge, all together to launch Carnation Capital, to be the specialized and alternative finance partner to the trade, but also the investment partner to clients that were interested in the wine and spirits industry and looking for secured assets with consistent and transparent returns. So that is kind of the story and the history behind Carnation's strategy and how I'm kind of positioning myself now to launch this and to grow it further.
That sounds great. Couple questions. We got a bunch that we've had sort of sent in, but just from what you've been saying, how do you value the inventory that you're basing the credit on? Like, if it's an established vineyard or winery, I guess it's reasonably straightforward. You take previous sales and amounts and things like that. But do you look at brand new producers as well, or is it just more established ones?
Yeah, absolutely. So I'll give the best way I can maybe explain this as an example of a deal that's actually in the portfolio at the moment. It's a whiskey distillery. So they actually set up, in terms of first brick laid on the ground was 2019. But they're not yet actually producing or selling. So they are at the moment looking for financing to fill the whiskey casks. So in theory, everything is obviously a projection. So there is a methodology that we use to look at to gather a good loan to value. But also the most important thing as well is the stress testing as well. So there is a methodology that we look at, and we always start from the bottom up. Meaning we look at what is the book value of the raw content of the spirit itself, what is the value of the raw cask that they've used, whether it's bourbon, ex-sherry, or whatever. So everything starts book value and going up rather than top down, which is market value and working down, especially when it's a new company. Then there are various provisions and adjustments, discounts that we make, but the most crucial component that I would say is the liquidation discount itself. And we vary that liquidation discount from 20% all the way to 40% in our kind of weak case scenario. So what it comes out is that an LTV that would range typically between 45 and 60%. In the case of this distillery, the LTV range actually came out to be 55%. So it is much more conservative, just given that it is a younger business, it is a new startup, and everything is kind of based on projections. On that point, when we look at then kind of the stress test, that's when we really look at what is a suitable base case. And I can kind of go through the different percentages for that, but typically our base case always starts at 90% of whatever the company has provided us. So whether it's actuals or projections, and then it ranges from 90% up to 50%. And we apply financial kind of metric stress test as well as market base. So kind of if interest rates were to increase as well. So we do look at new companies as long as we have the right kind of metrics and the right calculations that still come out to be EBITDA positive on a weak case. But typically the businesses that we are focused on have proven cash flow, especially during up and down cycles. And the wine industry, as you know, has gone through a lot of cycles, even just in the last 15 years. So there is that historic performance that we look at to show, not to predict the future, but to show how they've been resilient in the past and what other different income sources or strategies or markets have they tapped into to diversify and maintain that cash flow.
That makes a lot of sense. Thank you. So, I mean, I've been viewing this as a wine trade finance focused opportunity, but you're talking about whiskey. Are there spirits involved in this as well, or is that just a previous example of how it works?
No, I mean, maybe if I kind of ask you to pull up the first slide, then I can kind of go through the different, how the fund actually is made up, what are the different components, because as you say, I've switched between wine and whiskey, and that's one of the advantages, I guess, in terms of being diversified. And there are three different ways that I can kind of go through. But yes, we do look at, I mean, obviously I'm based in Bordeaux, which is wine capital, but actually whiskey is also produced in France. And we do also look at whiskey businesses in the portfolio.
Okay. All right. Have we got this?
Yes. So kind of looking at how is the fund made up, and therefore how does that determine or how does that contribute to the target returns of the fund? So there are three different components and three different kind of diversification strategies. The first is the product part. So as you can see, the majority of the fund, so 80% of the fund, looks at private credit, and up to 20% would be private equity investments. Now, within the private credit, there are then three solutions. So one of them, yes, is that trade credit component. And essentially that is what I call a purchase of stock and a resale of stock. So that is fully secured. And that typically, that purchase and then resale happens typically over a 12-month period. The second kind of secured component is that debt lending. So that's very classic. Typically that's between 1 and 3 years, fully secured as well, either by stock or by vineyard land or other kind of physical assets. And then the third component is the invoice financing. Typically that's, I say unsecured, and that it's not secured against physical wine or whiskey or real estate, but there are other collateral that we look at, for example, bank accounts, cash collateral, or other types of receivables to have a different, kind of have a supplementary repayment option as well. But also for invoice financing, that is typically shorter term, so between 30 days and 120 days. So you've also got kind of limited duration risk with that profile. So all those three kind of I bucket under private credit, and then up to 20% would be private equity.
Can we just quickly, like one line, describe what each one of these does? So debt lending is standard. Like I've got a vineyard, I want to plant more grapes. I want to borrow against the vineyard to do that. Invoice financing is like I've sold my wine to a distributor in the UK. They're paying me in 90 days. I want the money now. Yes. And then trade credit is I've got, I don't know, 30 barrels of whiskey aging for 3 years. I need the money now. I'm going to sell them to Elaine for 60 cents and then buy them back for $1 in 3 years. Is that?
Yeah, it does. I mean, in essence, you've nailed it on the head on those three. And for me personally, I'm very excited about the trade credit piece because, of course, beyond, I mean, the returns speak for themselves. They are, in that kind of higher range as part of the portfolio. But what this does is actually remove bottlenecks for both the producer and the purchaser. So I'll give you an example of one that I'm looking at the moment in the portfolio. And so let's say, a producer sells a bottle of wine for €3 to the distributor. And typically the distributor would then buy that, buy it from them and then sell it onto a shop, let's say for €7. Now, let's say the distributor can only secure that price if they buy a very, very large quantity, which is, fine for the chateau. They can get rid of a lot of stock. Not so fine for the distributor who has to pay cash up front for a lot of bulk stock that, let's be honest, would take between 6 months to 12 months to sell. If we're buying, let's say, even 10 pallets worth, or let's say 100,000 cases, that's going to take time to sell. So the distributor is out of pocket day one and has to recoup that over 6 to 12 months, but he wants to do it because the margins are very, very healthy. Or the chateau risks losing that deal because he can't exactly extend payment terms for that long. So that's where Carnation Capital can come in. they can purchase that stock on behalf of the distributor. They would pay the chateau the producer that €3 a bottle. We would apply our 14 to 20% margin and resell that to the distributor over that 6 to 12-month period, so they can repay us, as they sell that wine or whiskey over that period. So we get weekly or monthly payments. Sure, they lose a bit on the top in terms of the margin, but they between €3 and €7, is the distributor going to care if they lose 60 cents on the dollar for that? They're not, because they've secured a very large volume for no cash up front and have that long lead time to sell that stock as well over 6 to 12 months. And in the meantime, that stock is ours until it's sold. So we also have that security.
That sounds like there's a lot of margin there. How does that go wrong? And then I guess, how do you protect against that?
The biggest, I think, thing to get comfortable with, as in between us and the borrower, is the time that it will take to actually sell that wine or stock, and who they're selling it to, because obviously, if we can say, let's say 12 months, depending on the market, depending on the appetite on who they're selling it to, that could not even be long enough. So actually we do provision for that and have a stopgap that either they can only renew or extend if a certain amount of that stock has been sold. And then if, let's say, they've sold 80% of it and there's a remaining 20% left, depending on what stock that is, especially if it's stock that investors in the fund, would be attracted to, we would actually potentially offer that stock as a direct allocation to clients in the fund if they wish. Otherwise, only when that 80% of that stock is sold can the borrower either extend, renew, or so on. So there is a stopgap. We don't perpetually kind of allow for renewing and renewing and renewing. They actually have to show a significant amount of that stock to be sold. But I like that option, because if we're buying and selling, Grand Cru Bordeaux or Premier Cru Burgundy or Scottish whiskey or rum barrels, and we've got 20% of that stock remaining in the loan, but we've purchased it at that kind of distributor price, and that's significantly lower but below market. I want to be able to at least first offer that as an attractive direct allocation option to investors in the fund, especially if we have good, healthy consumers in the fund as well that they want to buy and drink. I want to offer that as the first kind of, first right of refusal. Otherwise, the classic structure of the fund repayment follows.
I guess as you build up the Rolodex of clients in the space, distributors, retailers, that kind of stuff, you'll have other opportunities to sell on the stock if you need to, in sort of like a worst case.
Yes, exactly. So obviously I mentioned that I'm based in Bordeaux, but that was semi-true and also semi-not true. I actually am based between Hong Kong, Bordeaux, and the UK. So my dog is not a fan of it, but I'm a fan of it in terms of finding distribution partners. And I chose these 3 markets, and obviously that follows the geographical diversification of the fund, kind of the second pillar there. Those 3 markets are probably the 3 biggest and the 3, I would say kind of wine friendly in terms of markets. So UK, you've got HMRC government approved bonded warehouses that have been in place for decades. So that there is, that kind of authenticity, that check, that good storage condition that's in place. And same with France. They have government secured, government approved warehouses. And they're also, favorable kind of tax policies as well in the UK. And also the UK has always been a big consumer of wine. So I'm looking for hubs that have good storage, and good practices, but also a growing or a very established and growing middle class kind of consumption market as well. So then that for me gives me 2 reasons to be confident. 1, that my borrower has a ready market to sell the wine, or 2, if I need to find a distribution market, I have distribution partners set up in markets like the UK that are ready to take that stock because there's a ready available demand. Same with Asia and in Hong Kong. I mean, Southeast Asia is a very exciting time at the moment. You've got Philippines, Thailand, Malaysia. Those 3 I'm very bullish on in terms of appetite and discovering luxury and discovering fine wine. The price bracket per bottle that they spend before versus what they spend now has increased significantly, and a lot of eyes are going towards Southeast Asia. For me, I'm based in Hong Kong as my kind of base there. There's zero duty on wine in Hong Kong, and it's been in place since 2008. So Hong Kong has always been and will be for some time a big funnel, if not domestically, but also to other Southeast Asian markets. And so I've also set up distribution partners, key ones, two main ones in Hong Kong that are able to also take that stock and utilize their client networks, not just clients, but restaurants, hotels, private collectors, private individuals, where they have a foot in the door with clients in all these markets. So I need to diversify that distribution as much as possible as well. So that's why I've been based between the two, so that I cover kind of the European and the Asia borrowing market, but also the European and the Asian distribution market to match that.
Okay, great. So speaking of diversifying, you're doing both wine and whiskey, yeah?
Yes, so obviously wine being kind of I always started with wine because of just studying the WSET and working in a wine investment fund. But whiskey, obviously, when we talk about barrels of wine for, let's say, en primeur, it works very similarly to also barrels of whiskey. Now, actually, since 7 years ago, I myself have also purchased casks of whiskey. So I have 3 casks in the Faroe Islands, I have 2 in France, and I have 1 in the UK. And so I naturally started to learn about kind of the evaporation, the angel share, the process, the aging period. And I said whiskey, and there are even whiskey distilleries in France that are set up by wine owners and winemakers. So the two go hand in hand. I think the valuation model as well, when you look at what is the book value, what's the market value uplift, the methodologies are the same, even if the price points are quite different. So yes, I think it was important to diversify between the two, especially when you look at markets where some, for example, India, they drink a lot of whiskey, less so on wine. So then you can also diversify markets as well, depending on that. So the idea is to diversify product, geography, and asset, but still keeping within a very focused and niche strategy, and bringing that all together. That's how it can contribute to the 15% target returns for the fund.
Are the whiskey finance options as sort of immature as the wine ones, or are they further along?
The companies, you mean?
No, so you're saying that one of the reasons you got into the wine trade finance, debt lending, invoice financing space was because there are so few finance options that are sort of fit for purpose for vineyards and wineries and stuff. Is it the same case for whiskey as well, or are those more mature?
It's a mature market in the US, and I don't cover the US. So I only make investments in Europe and Asia. And if you exclude Scotland, the rest of Europe and Asia is a brand new market. So yes, so that's why I also find that quite attractive. For example, obviously in France, that some regions have been making whiskey for quite some time, but it's still what's classified as a new world whiskey region. So it's not necessarily the case because it's young. Some of the companies that I'm looking at have been in place, let's say 3 years or 5 years. There are also merchants that, whilst they are a broad merchant, the asset that they're looking to collateralize or securitize could be spirits. So one UK-based merchant actually is looking for financing for rum casks. So it kind of crosses over geography and product. I think the theme in general at the moment is that with banks, there is a very low appetite to extend new lines of credit. So there are refinancings of existing lines that are happening. There are repricings of existing credit lines that are happening. But to secure brand new facility lines, I think less than 20% of the entire deal flow that transacted last year was new financing. So there is a low provision and high demand. So already I like that kind of competitive space. Secondly, I think the biggest pain point is, even if they could go to find a bank and to ask financing, which they can, I ask all my partners, I hope I'm not the only one that you've spoken to, because if that's the case, my answer would already be, a no. I want them to get appetite from other financial providers. But one common feedback I've had back is, if a bank takes the stock as collateral, they want that stock to sit there because they want to know that it's not going to move and it's not going to change and it's going to be good as gold at the end of the term. Well, that doesn't work in the wine and whiskey industry, because wine, you've first of all got two hemispheres, so two different harvests, two different big periods of release. And that stock, people want that stock to sell. It's not like a vineyard land that doesn't move. That's fine, but selling stock is good for us, for bankers, because that means our loan gets repaid. So, and banks don't understand that. So how can a business use their inventory as collateral if that bank wants that collateral to never move? If collateral doesn't move, then wine and whiskey businesses can't earn money. So there lies that bottleneck. To give you an example of how I've combated that with one of the deals, I have taken a debt lending deal where I've secured, the loan is secured against whiskey casks, and I allow that company to sell 20%, up to 20% of that value. And I'm very comfortable with that, because the more they sell, the more that my loan gets repaid on time. But they must refill that value within 60 days. So there is that stopgap, but there is that breathing space that I can give to those companies to maintain that cash flow. But they must cure that, or they must fill up that value within 60 days. Any more than 20% would not be consent, wouldn't be given. So then there is that compromise and that workaround that has to be given, especially if I choose to be specialized, then I have to operate differently to a bank. And that's how also that understanding allows me to also apply a higher interest rate, and why they're willing to pay it, because they get that flexibility with someone like me that they can't otherwise.
Okay, that makes a lot of sense. Thank you. We've sort of inadvertently covered off like half of our questions. That's great. So just talking about inventory a little bit, since we're on the topic, a few of the folks that I've spoken with have sort of had hesitation or pause because they've dealt with wine funds before, or whiskey funds, where essentially it was a bunch of fraudsters who sold the same cask to 8 people. And then at the end of the day, like when the whole thing wound up, the guys were gone with the money and they had 8 people fighting over the same cask. How do you guys ensure that the collateral that you're lending against isn't subject to that? How do you know that the wine's actually there and that it's actually allocated to you guys?
That's a very, very good question, because even though the fund itself is not a buyer, right, of stock, we're not trading it, and one of the underlying collaterals, I guess, is the wine and whiskey itself. So we do treat how the collateral, first of all, is stored and managed, but also the value very, very seriously. And I think for us, the first thing we always start with is what is can they provide a purchase or sale order invoice? Now, it sounds very simple, but actually this is probably the most important starting point, because that's the audit trail of where that stock has been and gone and who actually has it. And we always try to minimize the legs in that journey as much as possible. So let's say once removed, meaning it's gone from chateau to negociant, or and that's a very specific model just for Bordeaux. So obviously sometimes there is 2 layers as well: chateau or producer to merchant, producer to negociant, then to merchant, which is a very specific thing just for Bordeaux. But that's it.
Explain what a negociant is for folks.
Yes, so it's a word that I think is most associated with the Bordeaux trade. It's essentially there are several intermediaries in the sale and trading of wine, and particularly so for Bordeaux, where most, let's say, have 3 steps. So you've gone from producer to a distributor, and then that distributor sells to a merchant. Let's say, it could be a retail shop, it could be a hotel, it could also be a wine business. Bordeaux just has that one extra step, and that person is called a negociant. And that negociant sits between a chateau or producer, and he acts a bit like a distributor, but in some instances, it's just the step before. They are basically they act as the commercial face and the allocation decider for producers. So where it comes to Bordeaux, that additional step is needed. So we understand that, and that's why 2 layers removed from the source is normal for Bordeaux. And for any other region or for any other product, especially whiskey, we typically only look at source or one additional layer. So that's why having that purchase or sale order is so critical, because we can see, let's say we're working with a merchant in the UK. They will always have that purchase and sale order that goes from them to the negociant, and that negociant from the chateau. And then we know the trail, and it stops there. With the chateau, of course, if we're working with them, it's always going to be at the chateau's warehouse directly from them. They are the source. So we always start with the invoice. It's a bit like KYC for any kind of company. If they can't produce an invoice, we don't touch them, because that's not valid. We verify and inspect every invoice. And for certain deals, especially the amount or the tenure, all the assets in the warehouses are also physically inspected in person. So that's why I'm also traveling to the UK or to Asia to inspect that stock myself. Photos are taken, reports are taken. And on top of that, we also ask for the insurance policy as well, that also has that stock report. So those combined go hand in hand. The second layer, that's the first layer, kind of, if I'm taking myself as the first layer in that process. The second layer then is that we also then use independent agents and consultants to also then value that stock. So in the case, if we're using a warehouse, the fund's warehouse partner is called Bordeaux City Bond. They're actually partly owned by the Bordeaux Chamber of Commerce, and they use Sotheby's as their valuation and authentication agent. So then we also rely on their secondary report to validate ours, for example. So I think that is the most important thing, is in-person invoice verification, and then third-party respected, reputable platforms or agencies to help. And the fourth thing is the insurance report and the insurance submission document. And I think that really solidifies the value of the collateral. I would say one other thing I would add is we also look at other forms of collateral besides stock. So I think that slide that you put up, you can put back on again, because I think that really covers how we look at the collateral management process, because obviously when it comes to the collateral is important when it comes to borrower default, right? But we also want our covenants as that early warning sign of this potential, so that we can act sooner. And the strong collateral packages in place so that we can recover that capital if the default does happen. So, yes, thank you. So, so beyond stock, we do also look at, as I said, other forms of collateral, and especially in assets that are a little bit more liquid. Now, since our fund distributes cash interest every 6 months to our investors, we need to look at other stock that also that is more liquid to be able to meet that obligation. So that's why on some deals we take a charge over the operational bank accounts of the company, and that's why we also look at potentially share pledges, but also other receivables or other bank accounts as well that could be available. So there is always an alternative means of repayment that we can tap into. At the end of the day, we're a private credit fund. We're not a wine distributor or wine merchant. So whilst having the stock is good, we also don't want it at the same time, because we want the cash. So that's the key part of the collateral. It's a mix of stock as well as other forms of collateral that are a little bit more liquid. And the covenants are there to help us monitor and detect on a regular basis and essentially get a health check on the company regularly enough. So hopefully we don't have to call on that collateral. One of the things that I think is probably the most critical is that is the cross default and the cross default trigger. And sometimes we apply that threshold even as low as 10% of the value of the loan that we've extended, so that we can benefit from any early warning signs and act on a very, very regular basis and have that check-in. We ask for sales to be reported. We ask for bank account statements to also be reported. And that just, that gives us that on a monthly basis, I should say, on a monthly basis, we are conducting that kind of health check and screening of the company. And annually, we do a revaluation of all stock-based deals in our portfolio. We compare that to competitors, and we use third-party platforms to verify so that we can make any adjustments if needed throughout the life of the loan.
That's great. That's I think the most rigorous explanation of risk management that I've heard in sort of any of these kind of spaces. That's super impressive. I'll hide that away. So I think we'll wrap up with kind of like elephant in the room sort of thing, like macroeconomically, big picture wise, things are pretty spicy right now. Like, how do you think that's going to affect Carnation? And that's hard to guess, but how do you, I guess maybe a better question is like, how do you protect the downside in such a chaotic environment?
So I actually have to say that chaotic has been good for me in Carnation, and actually I feel that I've timed coincidentally, not planned, but I think the timing of the launch of Carnation has come at a good time, because what I have found is that, I guess from the investor perspective, first of all, there are many lovers, appreciators, collectors of wine and spirits that still want that exposure. But yes, the market, where it's at, dropping and also being inconsistent. We've had insane price hikes a few years ago to now 20, 30, or even 40% drops. That has, I would say, lost some confidence, some investor confidence in investing in a traditional sense in the wine industry. So coming at it from Carnation's perspective, to say we are still exposed to wine and spirits, but not in the trading sense and not in the speculation sense. I think it's maintaining and capturing still that interest and that exposure that people want to the industry, but doing it in a way that it's private credit. So it's loans, it's debt, it's a consistent interest rate. It isn't plus 20%, minus 20%, weekly or monthly swings like that. The difficulty I have found, though, is actually having that conversation, because you're kind of it's the same table, you're just turning it upside down and having a different conversation. So kind of changing the mindset to say it's wine and whiskey investment, but not investment in the sense that you're buying the stock and selling the stock and holding it for 5 years. So I think now's the right time to have that kind of conversation, especially when from a macro perspective, private credit is also have become a very attractive asset class globally. I would say it's more advanced in the US and in the UK, less so in Asia, but everyone is catching up, because the interest rate environment at the moment is quite volatile, change of policies and politics, tariffs, everything like that. Private credit offers a bit of stability, but also above yield in terms of above corporate bonds and fixed income. So I haven't seen many combinations of private credit and wine and spirits out there. And so I think being that bit niched and specialized like that has been an advantage in a time like this. I think for me, where the challenge also is especially with borrowers, is interest rates, right? Borrowers always want to pay low, especially if you're kind of tracking against the market. I always want to charge high so that I can give a return to my investors. So what I originally I thought about doing a floating interest rate, but I think given that it's a shorter term fund, it's 3 years, the fixed made sense. And I want to, as I'd gained that trust of investors, that there was a guaranteed return rate, every 6 months and every year that they could rely on and believe in. And I think we are going to come out of this market cycle for wine and spirits, and there will be more competitors who want to kind of fund. We're already seeing this in the US with the launch of American single malt, and there are a lot of new players coming into that space. And I think Europe and Asia will catch on, especially Asia, very quickly. And I'm excited to really see how that would work as well in Asia. So I think especially with the tariffs, that's actually been in my favor, because everything is looking more domestically. And domestic consumption in big markets like China, like India, like the US are huge markets to, it's not, you're capturing a very, very big market share in just one country alone. So if you can be that kind of specialized player in any of those markets, I would definitely prefer to be that. So I have found it to be a competitive space and in a good way for Carnation Capital. And now I'm just hoping that I can meet like-minded investors, enthusiastic, interested investors as well, that believe still and very interested and passionate about the industry, but looking for a different kind of return.
That's great. Thanks, Elaine. I think that's all we had from folks who submitted questions. What haven't I asked that I perhaps should have?
So I guess one thing that I perhaps could allude to, I mean, we talked a lot about the finance structure and the credit side, but I think one thing that typically always gets missed, but is also an equally attractive kind of advantage of being in this industry, is the social aspect. We're talking about wine and whiskey, not stocks, not bonds that you can't sit on a table and get a share deposit certificate and split that in 6 ways. A bottle of wine or a bottle of whiskey, you can do that. It is so convivial as an asset class, and that's one of the reasons why I wanted to focus on it. So one of the things I guess I wanted to add is, beyond the investment performance and the investment return of the fund, the one key aspect I also wanted to create, or at least protect in a way, is that sharing nature and that experience as well of investing in this kind of sector. So that's why the direct allocations and the direct referrals to chateaus, producers, or negociants would be the baseline. But every quarter, I also organize wine tasting dinners and events to, first of all, so that I can meet investors in the fund. They can also meet like-minded individuals, but also that I would have a winemaker or a distillery or producer actually at the dinner, and they may come from the portfolio and a borrower themselves. So our investors can actually meet the people that are actually in the portfolio itself and meet them on that more social basis. I always say, if you invest in Apple stock, you can't exactly go to California, knock on the door of the office of Tim Cook and go have a chat with him about Apple stock. But in theory, you can actually go and meet the winemaker of the portfolio in the company itself, drink his wine, share his wine, and bring people together. So the important aspect for me is creating that connection between myself, my partners, the borrowers, and the clients as well, and actually get together and have that convivial and that passionate sharing experience. So that is part of the fund. Any investor that comes in would have access to direct allocations or to events, and they are free to kind of opt in and opt out as much as they want from that. That's
great. I think you'll get a lot of takers for that, especially our crew.
Especially, I think the Bordeaux. I mean, last year I organized a visit in Bordeaux for very select kind of the early investors of the fund, and we spent 2 days doing whiskey. We went to a barrel making facility in Bordeaux, which if no one's ever been to, I highly recommend. It's such a big part of how wine and whiskey is aged. So to know how a barrel is made and the industry of auctioning for wood was incredible. But I organized that, and also a couple of visits in the right bank and in the left bank, followed by a dinner with a winemaker and distillery maker as well at the end. So the idea is to kind of bring to life the fund and the portfolio.
That's great. Yeah, I'm gonna gonna RSVP yes.
Good, good.
Well, great. Thanks, Elaine. I'm going to drop this into our space, and Altea folks can go in there asking for the questions. You've got access to that as well. So any questions in there, you'll be able to jump on and answer. Thanks so much. Appreciate it.
I'll have a profile, and anyone can kind of nudge me and or poke me for any questions. But thank you, Wyatt. It's been a pleasure, and good to have a chance to get to speak with your investors in your community. So thank you.